The Treasury yield curve suggests that we are headed for a recession, and here's why I'm not sold on it. You should know what the yield curve is because it shows investor sentiment in the future. When the United States government issues debt, it generally does it in the form of Treasury bonds, and you could get a 2-year, 5-year, 1-year, 3-month, 20-year bond. And each of these bonds gives out an interest rate per year that you get to make some money off of. So let's say I buy $1,000 of, let's say, a 10-year Treasury bond. If that interest rate is 4%, I get $40 a year. Historically, people always like to compare the yields between the 10-year Treasury bond and the 2-year Treasury bond. And the difference in yield between these two bonds is called the yield curve. If the economy is doing well and people think that the economy is going to do well in the future, they're expecting higher interest rates and a higher treasury yield. If the opposite is happening, the opposite is expected. In a healthy market, people think that the economy is going to be better in 10 years than it is in 2 years. That's why the 10-year yield is generally higher than the 2-year yield. But right now, unfortunately, the 2-year yield is higher than the 10-year. When that happens, the yield curve is inverted because the 2-year yield is higher than the 10-year, which is bad. The reason why people think it's bad is that it is predicted 8 out of the last 10 recessions. You should pause to look at this chart and study it for 10 to 15 minutes. It was made by Benjamin Cowen, and it shows the yield curve and when there were recessions. These red triangles are the length of days that the yield curve was inverted. So in the early 1980s, it was inverted for over 500 days. Shortly after and during, there was a recession. Same thing in 1990, same thing in 2000, same thing in 2008. But there is a big catch here that makes me very skeptical. The yield curves may signal that there's going to be a recession, but it actually can't tell you when there's going to be one. There have been times where it took a recession 2 years to happen after the yield curve got corrected. That's not very accurate. People keep forgetting that the world economy is constantly evolving. So if the last recession took 2 years to happen after the yield curve inversion, what if this one that's going to happen will take 3 or 4 or 5 years? How accurate will the yield curve be then? And the fact that the yield curve is only 80% effective for predicting recessions, for someone like me who has a master's in statistics, is highly inaccurate. I am looking for a confidence level of 95% or above. Each time that the yield curve has been inverted over the past 50 years was either because of tight monetary policy, real estate, or a terrorist attack like what happened in 2001. But it looks like inflation is coming down, suggesting that we're going to stop raising interest rates or even lower them. The US economic growth output was just upped 5.2% growth in GDP versus the predicted 4.9%. If you're thinking about a real estate crash, housing inventories are at their all-time low. Demand is still very high. Home prices are very high. It looks like the 2-year yield is starting to come down to the 10-year. In fact, I just made this chart showing the 2-year yield. This 5-year yield is the red, and then the 10-year yield is the blue. And look at this. The 10-year yield is just a little higher than the 5-year yield, meaning there's sentiment that the economy may be better off in 10 years than it is in 5 years. The only thing I could think of right now at the top of my head that could throw the United States into an economic recession is if the rest of the world suffers a recession and it starts to affect the United States. Either way, I can't completely dismiss the yield curve inversion, but I'm definitely not going to swear by it as gospel. I interpret the yield curve as, just in case this happens, hold a lot of cash because there's a chance that assets of all types, even gold, will become much cheaper. I want to talk a lot more about this. If you guys like this post, please like, share, follow, and let me know if you want a part 2.